Before I start and it goes on record, today welcome you to the EGROW webinar series that we have been doing on Fridays. And we have already done more than 300 webinars by now. And we feel very, very good that all of that is in the public domain. We have been, over these years, taking up issues which are of contemporary interest both within our country as well as globally. So we are very fortunate in that sense that we had the opportunity, thanks to Professor Ashima Goyal, for the G20 presidency. We did about 21 webinars, 11 on new international economic order, 6 on climate and 5 on women empowerment. We have also had the good luck to host 5 Nobel laureates. And we have been working on issues other than main core economic, socio-economic issues, as well as geopolitical issues. These days, we are working on a series of states learning from each other. And in that series, we have covered about 20 states. This time and last time, we had lined up states from Northeast, but we had to request them for a postponement to December. That's the earliest slot we have, because a very contemporary important issue came up, and that is the discussion paper on monetary policy framework released by the Reserve Bank of India, seeking inputs on that. And that monetary policy framework document, about 25 odd pages, is focused on inflation targeting. We have done about 9 years of inflation targeting already, and there is a spectrum of views on it. On one extreme is me, who feels multiple indicator approach was doing a great job, there was need to replace it. And on the other extreme are others who think that what has happened, and it should continue the way it is. I think the governor, new up there, has brought in massive changes, all very positive changes. And in his wisdom, he has got this paper released. So I look at it as a great opportunity for the economist community to deliberate on the issue and think about it. Also, just want to flag one issue, that it's only now that the Prime Minister has given the economist a task of Viksit Bharat, and therefore this issue becomes, according to me, far more important now if we have to play a role in Viksit Bharat. What should be the inflation target? Should it be a band? Should it be there in terms of a point target? And should the band move, or is it okay where it is? Are the type of questions which the discussion paper has flagged. Being a very contemporary issue, we thought we will dedicate 2 Fridays on this. And dedication was on a pattern. Last time, EGROW Shadow Monetary Policy members spoke. Today, former MPC members are speaking. Last Friday, the session was chaired again by a non-MPC, non-EGROW member, Professor T.C. Anand. Today's session is being chaired by our advisor, Dr. Bhalla, who has not been an MPC. The panelists, 3 panelists, are MPC members. So this is how we structured the discussion on inflation targeting in our quest to give some input, whatever it be, to the monetary authority as to what our views are on the inflation target. As I mentioned, to chair the session, we have Dr. Bhalla today. He's our advisor, and he's been with us on the panels many times. So briefly introducing him, he is the former ED of the IMF. He's also the former member of the Prime Minister's Economic Advisory Council. Our first panelist for the day is Professor Dholakia, again well known on our forum. He is a retired professor from IIM Ahmedabad, where he has taught for nearly 38 years. He has been extensively on various committees of the Reserve Bank. He's on the board of the Reserve Bank of India right now, and he's a former member of the MPC. Next panelist is Professor Ashima Goyal. She is also our advisor. She has spent long years at IGIDR. She is former member of the Prime Minister's Economic Advisory Council, and she is also the former member of the MPC. Our last panel for the day is Professor Shashanka Bhide. He is an honorary senior advisor at NCER. He has been with NCER from 1982 to 2014 in various capacities. And he took up the position of Director, Madras Institute of Development Studies, Chennai in July 2014 and served in that position until December 2018. He then joined NCER in the present position in September 2019. He is also the former member of MPC. With this brief introduction of the illustrious panelists and the chair, I hand over the proceedings to Dr. Bhalla to take it further. Sir, over to you. Sir, you mute. Sir, you mute.
Yeah. Thank you very much, Charan. And, I've been asked to comment or lead a discussion or chair a discussion by macro experts on inflation targeting on a paper written by macro experts at the RBI on inflation. So this should be exciting. Hopefully, will be informative, and we'll find out if we have learned anything in the process. Just a little background: the first IT inflation targeting country was New Zealand back in the 1980s, and in the aftermath of the global inflation of the 70s and early 80s, and in the aftermath of Volcker's killing inflation around the world, such that by the time the inflation targeting started in New Zealand, it was already world inflation was already on its way down. And indeed, what the data shows that except for the first three countries, I think New Zealand, Canada, and one other, that by the late 90s, many countries have jumped on the bandwagon of inflation targeting and really have not shown that their introduction of inflation targeting led to any obvious benefits, either in inflation or in higher growth. Now, our own story in India was that we adopted it in the aftermath of the highest, exactly what the US had experienced in the 80s or late 70s, early 80s, that we had an average of about 9% inflation for close to a decade. And so therefore, absolutely no question that we needed to bring the inflation rate down, and it is down. My question is, what has, as Tina Turner would say, what has inflation targeting got to do with the fact that the inflation rate is down? Two other points that the RBI has asked in their discussion paper, that what are the policies needed to maintain price stability while keeping in mind the objective of growth. Now, both these clauses have a very high standard deviation. What is the objective of growth? And it would have been nice if the discussion paper had said that, look, the objective of growth is the following. This has been the variation in growth, and this is the objective of inflation, which is clearly defined in a very, very high band. Notice that the 2% lower band has yet to be breached. I think we breached it for 3 quarters or 2 quarters, but on an annual basis, it has yet to be breached. So I will conclude by saying that I'm really looking forward to this discussion and looking forward to hear the views of the experts. My own concluding comment is that I wish that the RBI paper had been a little bit more explicit, a little bit more direct, and a little less wishy-washy as to everything goes. So let me start. I don't have the order. Which is the order, Charan? That
I leave it to you, Professor.
okay. So I'll go by age since I'm quite old myself. So I think my guess is Dholakia is the oldest. Is that correct? And then we'll move to, I don't know, between Mr. Bhide and Ashima.
Now you're in difficult time.
Okay, so shall I start?
Yes.
Thank you, friends, for this wonderful opportunity. In fact, it is to comment on the RBI discussion paper. It is very, very relevant that we have a formal forum where we talk about the inflation targeting in a systematic way. By the way, the last date for submitting the reactions or comments or feedback to the RBI is over yesterday. But I understand that they will be open to have any other inputs or any other kind of feedback, comments. If it is well studied, I don't think that the dates will so much matter. They should consider, in my opinion. First of all, let me congratulate by saying that the governor has taken special pain to ensure that the discussion paper is out, and there is enough time for the public to opine, react, and then the RBI can take a view and submit their proposal to the Ministry of Finance, which will be then taking the final decision by March. I think that is the process. Unfortunately, this process was not very well followed during the previous thing. When the previous review was there in 2021, this process was practically absent. It was not any kind of a very large public discussion was invited or made, and we decided to continue with status quo. What I am somewhat disappointed is about the quality and the content of the discussion paper. The quality and content of the discussion paper this time could have been much wider, whereas here the scope is very narrow. Number one, they are saying that it is only 4 questions on which they invite the answers and the feedback and comments, actually assuming thereby that all other issues and all other questions and all other matters pertaining to the inflation targeting in India have been resolved or are irrelevant. I think that is the view that the discussion paper seems to have taken. Another very relevant thing that I find is that while they have tried to survey the literature and try to talk about certain papers and certain other kind of things, they have done their own analysis also. But all the things, let me tell you that it is far less objective and far more subjective. The references are selective. They are ignoring several studies which should not have been ignored, and they are not presenting the opinions in a dispassionate way. In fact, these opinions have been expressed more with a clear bias, and there is a clear-cut opinions which are very much there in the discussion paper, which I don't know. I mean, if I were in their place, I would avoid such things. Very relevant matter is that several issues are brushed aside. I don't want to get into that because on various other occasions, from as long back as 2017 onwards, I have been. In fact, 2016 we started with the formal adoption of the inflation targeting, and the formation of that first MPC committee was in September 2016. I think we are completing 9 years of MPC, and what is happening is that during this period you have achieved, you have not achieved, you are showing that you have achieved. I think this is all matter which are very much discussed in the discussion paper, and I presume that the audience is fairly aware about that and they have read the discussion paper thoroughly. So I'm not going to get into what the discussion paper is talking, but my comment by and large is that the quality of research is somehow a careful researcher would avoid certain things which are not avoided in the discussion paper. Like, say, for instance, the clear measurement issues which the first MPC had taken up, because there was an implementation of the 7th Pay Commission during the tenure of the first MPC, and we had to, there was no choice but to ignore certain kind of the things, and we had to make adjustments, and we said that we will look through certain kind of the spikes in the inflation arising out of pure statistical methods of estimating the house rent allowance, etc. I think these kind of things have been very quietly ignored, as if that those things never existed. This brings me to my first point. In fact, I have been expressing the opinions and very studied kind of reactions to the entire issues on several occasions. 2017, 2018, where I'm talking about the 2017, I talked about the sacrifice ratio. 2018, I talked about the measurement issues. 2020, I talked about the overall macroeconomic framework and inflation targeting within that. 2021, again, a question of band about the point target and other things, and so on and so forth. I have been talking about these things, so I'm not getting in largely into those. But there is one more issue which I would rather like to raise here. The first question that they are raising, and I'm now confining myself to the questions that they are raising. The first is whether it should be headline or core inflation. Unfortunately, they have not considered the measurement of the inflation at all. Now, the measurement of inflation is a serious issue. And what they are talking about this year is that headline versus core inflation, and they are arguing that core inflation ignores something like 52% of the total consumption basket, and therefore the headline inflation is an obvious thing. You can't have a core inflation with 48% only. Now, the same argument, if I extend, then they should have first asked the question, is the basket on which we are talking about the consumer inflation adequately representative? My answer is no, capital no. Sir, we need to understand that it is based on, the weights are based on the consumer expenditure survey. And consumer expenditure survey constitutes less than 45% of the total final consumption expenditures, private final consumption expenditures in the country. So basically, the measure that we are talking about ignores, and this is something very relevant, ignores 55% of the consumption items. Sir, this measure cannot be considered as a target or for any other purposes. This is for some other purpose that we can consider the surveys, not for policy making with this kind of the targets. Okay. So first of all, that itself requires a question. We are talking about inflation. We are very, in fact, Professor Bhalla also, I was surprised. Professor Bhalla also talks about inflation. But sir, let us understand that this inflation that you referred to is only confined to 45% of the total consumption, private final consumption. It doesn't constitute all the 100%, because it is very well known. I don't want to give references in this. It is very well known in the literature that the surveys exclude the top 15 to 20 percentile of the income groups in the country. They are practically not covered at all in their consumption. Similarly, they are excluding once in a while kind of expenditures, or what is known as the consumer durable expenditures. They are also ignoring most of the services in a proper way, including the restaurant or the entertainment and many other kind of things. This is absolutely absurd. Therefore, if you have 45-46% of the weightage of food items, it is also a great surprise. I mean, you talk about the credibility. In fact, the paper, discussion paper, talks only about the credibility. On credibility grounds, several things are put aside and brushed aside. Sir, if the credibility is an issue, let me ask a question. Is our inflation measurement credible? Is our inflation credible at all? The numbers that we are talking about? Sir, it is not at all credible. In fact, there is a zero credibility. Talk about any theory that you are talking about in terms of, because when we talk in MPC, we talk about the theoretical framework and we talk about several relationships. Sir, which relationships are holding with this measurement of inflation? In fact, the credibility is zero, I would say. So if government has not done any effort to make this kind of changes, it is RBI's responsibility to at least point out and say that this inflation measurement, this metric that you are talking about, is not acceptable. Fortunately, I have gone into the details and I can find that the act on which, because RBI will promptly say that this is not our problem at all, this is the problem of the act. Act says that we should have the CPIC as the target, and we should really go by that. In fact, I have quoted it somewhere else also, that para 221, chapter 12, Part 1 of the Finance Act 2016, which is a RBI Act as amended by the Finance Act. These are all the details available. Nowhere in the Act it says that CPIC should be calculated on the basis of the household consumer expenditure surveys. Nowhere. That means there is a definite scope for us to really shift the weightage to make it more amenable, more palatable, and more believable, more credible, I would say. If you look at the comparisons of these kind of things, which are, I'm just trying to say something very, very categorically about this because I have done some research on this. You find that G20 countries, if you take the CPI food weightage, if you take the PFCE, that is, private final consumption expenditures as per the national account statistics, their weightage, and you take the share of the PFCE, that is the share of consumption in the GDP, and you take the imports, net imports as a share of the GDP, you make all the adjustments, then, sir, what is relevant, what comes out very clearly is that it is the PFCE weight which is exactly reflective of the weights of the sectors in GDP. Now, the issue that comes out is that you are talking about the inflation targeting, keeping in mind the growth objective. Sir, growth and inflation are the two objectives formally recognized by the Act. And the question is that if you have the measurements which are completely inconsistent of growth and inflation, then I would say we should forget about the policy making. Neither fiscal policy will make sense, nor monetary policy will make sense. If the monetary policy and fiscal policies have to really talk about these two targets, they have to be internally consistently measured. So, I mean, you cannot have 45% or 46% weightage in the of the food in inflation measurement and have only 16% or 17% weight in GDP. That doesn't make sense at all. If you have say 17%, 18% weight of food in GDP, sir, the corresponding weight in consumption turns out to be around 30, 31%. And that is exactly what is there in the PFCE. That means the PFCE, again, being associated with the MOSPI in several committees, etc., I know for sure that the PFCE is arrived at by considering 150 items. The household consumption expenditure considers 400 items now. Previously, it used to be 299 items. Most of the items do not match or do not make sense. If you are mapping the things, it is possible to really consider the weightage. I did that exercise, and what I find is that the new series that I generate, the consumer price expenditures combined with not the expenditure survey weightage, but the PFCE weightage, if I consider that, then the series shows much less variations over time, number one. Number two, its average also is really brought down over the time by about 60 to 70 basis points. That means that when you are talking about 5.5% inflation, actually, if you are properly measuring it, it turns out to be 4.8%. I'm just trying to put the things together. And the weightage and the entire thing is much credible and palatable in terms of the entire series. what is most relevant to understand is that the inflation dynamics also undergo a serious change. I have done the entire exercise on the basis of the monthly data, and what I find is that the inflation dynamics are exactly topsy-turvy. The current series shows that it is the headline inflation that follows the core. Whereas, if I make this adjustment and use the PFC weight to calculate the inflation, I find exactly the opposite thing, that it is the core that follows the headline. Once this kind of dynamics are there, sir, the first question of the discussion paper becomes irrelevant, because there is no choice between the headline and the core. It has to be headline, period. But the headline, when the inflation is more credibly measured and you have a correct kind of the weightages, that is number one. Having said this, now I go very quickly on the other two questions. 4% target optimal for balancing growth with stability. Sir, it is a very relevant question. That is the 4% target relevant? I have addressed that very comprehensively. In fact, they are quoting me also in the relevant paragraph, something like para 44, where I am arguing that the threshold inflation should be 6%, and you should actually raise the things from 4% to 6%. Or actually it is not 6%. If I'm just saying that this is selective because in the same paragraph with the same kind of thing within a matter of 2 sentences, sir, I'm arguing that the right kind of thing is 5.4%, not 6%. That is one thing. Number two. So the next question is that if you are talking about the why not 5.4%, their argument is that the global investors find the policy credibility in question if you are changing the target. Under these circumstances, which foreign investor considers India's inflation as credible? So this is my first question. If there is no credibility of the inflation at all, measurement, then there is no question of credibility of policy. Sir, you have to make a comprehensive change. That is number one. Number two, the same thing when you talk about stability, I have argued comprehensively in my
3 minutes more. Is that okay?
Pardon?
Can you finish in 3 more minutes?
Yeah, 3 more minutes. In fact, I will not take more time. In fact, in my TIS, that is the Econometric Conference presidential address, I have argued that the macroeconomic stability requires consistency among the 4 targets, namely inflation, growth, the fiscal deficit, and the current account deficit targets. We have all targets already set, and none of these are internally consistent. At least one has to adjust. The remaining 3 are very clear, as Charan Singh also is talking about, that growth is absolute target. The current account deficit is a very important target. The fiscal discipline is very relevant. Then the inflation target has to be consistent, and the consistent number is 5.4, not 4. Okay, that is number one. And then plus or minus 2% tolerance band is the next question, which I'm saying we need to have. If we make the measurement proper, then we can actually afford to narrow the target from 2% to 6%. Rather than that, make it 3% to 6%, no issues at all. 3% to 6% becomes my recommendation. And the last question is on range. Should we have a point target or a range target? I would say a point target, we have paid price. In fact, in the in the last MPC, there are two members here of the last MPC, and they know that if there is a point target, people have that achievement orientation. When 4.4% was achieved already, people were still talking about the Arjun's eye and the target about the 4%. As a result, we did not make any changes at all in the repo rate. Please understand that 4%, there is nothing sacrosanct about that. In fact, it's a range which should be considered as a target. And my very strong recommendation would be that keep it as 3% to 6% as a tolerance band, but 4% to 5% within that as the proper range for target. It is not a point target. It's a target, but not a complete range, but a narrower range from the overall tolerance band. So my recommendation would be, instead of the 2% to 6% range, make it 3% to 6%, but the point target should be replaced with the further narrow target of 4% to 5%. That is a flexibility. In my opinion, this is good enough. Thank you very much.
Thank you very much, Dr. Dholakia. And now, you raised some very pertinent and relevant issues. The first one, you said that basically the quality and content of the discussion paper left something to be desired. And my reaction to when I read it was how different it is than what Grok or ChatGPT would put out on the issue. And the second very important issue you raised is on measurement. I'll now turn to Shashank, and basically between 15 to 20 minutes, if you can keep it. Thank you.
Thank you, Professor Bhalla. And I should also thank Professor Charan Singh for this opportunity to be here. And I think it's a privilege to be here. It's hard to sort of follow Professor Dholakia, so I think I will probably stick to the points that I've tried to make, I guess, on the discussion paper, except of course recognizing that the issues that he has raised, especially on the measurement of the inflation and more particularly about the consumption. So I must say that I follow what he has said, but I think given the present concerns and the situation, I think it will take a longer time to absorb what he has said and what he has recommended into the computation or the measurement of CPI and so on. So I grant the concerns that he has expressed, and I have my own limitations, I think, in terms of assessing their sort of importance now for the discussion. So having said that, I should also say that the perspectives that I would like to share are more in terms of my experience in being a member of the MPC. So I guess it has more to do with the challenges that are faced, I think, in being in the framework of IT, inflation targeting framework. So I think that is the perspective at which I would like to make my comments. I should also say that unlike Professor Dholakia, I found the discussion paper fairly comprehensive, and I think it has taken into account the alternative views on the various issues that they have raised, and I think with the whatever limitations that they have had, so they have tried to come up with a few suggestions of their own on the questions that they have raised. I should also say that I am in agreement with many of the recommendations that they have made. So these are some initial points I would like to make. there are a couple of other points, besides these 4 questions that they have raised. I'll come to them at the end if it is time. So on the issue of this core versus headline, um, so I think my concern is that they have pointed out the um, sort of food inflation as the key difference between the core and the headline. I think issue for in the sense of assessing inflation scenarios and so on. It's not just the food. I think it has much more to do with the supply side or the supply disruptions. I think so. The concern actually is whether these shocks are temporary, transient, or are they permanent? I think so. This is at the core of the concern with respect to headline versus some more stable measure of inflation. So I think the focus on headline is important, and I think so. I will stick with the operating indicator as the CPI combined, for the reason that I think it is certainly for whatever uh, sort of deficiencies it has, it is more comprehensive than just considering core. And in fact, I would think that if we sort of take out some of these more volatile components, particularly food, from the headline, then I think we should also be taking them out on the output side, because I think many of these shocks that we have on this price on the price front, they also come from supply disruptions or the what are the impact of weather and so on. So therefore, does it make sense to focus on the entire output when we consider output, and consider only the core inflation when we consider inflation? So I come from that perspective that I think that headline inflation should be a good measure for inflation targeting. On the second point about the 4% target, uh, so you said the in order to so the target inflation is to sustain higher growth rate. I mean, so that is the background, I think, to this question. Is the 4% target is optimal? So if it were not to be 4%, if it is less than 4%, is that better for growth? Or if it is more than 4%, is that better for growth? Uh, so in the absence of my own expertise in this issue, I only uh, so I looked at the discussion paper and the point that they make about this threshold inflation above which the growth may not be will not be stable. And so Dholakia mentioned the threshold not at 6%, 5.4%. And I think the discussion paper itself talks about 4% from two of the um, you know methods that they have used to assess this threshold inflation. Uh, so the so I think the 4% by itself is probably not a very high target, and in the experience that we have had, we breached the upper band or the upper limit of the band of 6% a few times, but I think focusing or targeting the 4% has turned out to be, I think, sort of a reasonable approach than the deviations from that. So if we target focus, this is also in some ways tied to the last question that they have on whether it is a point or a range target, right? I mean, so I would say that based on the our own experience, I think the 4% target would work out to be um, work out to be a measure by which the stability in growth would also be achieved. So I think that is the second question that they had. Uh, then I think the third question was about the tolerance band of plus or minus 2%. Uh, so again, I think keeping in mind the volatile components of the target, uh, and and that I guess we have had breaches of the upper limit, um, a few times during especially during the last 4 years that I was a member of the committee. This is a concern. I mean, I think that whether the tolerance band of plus or minus 2% adequate. I think the issue is, I'm coming back to the points I made on the first question also. So the tolerance band, I think, is necessary in order to assess the nature of the shocks. So whether the shocks are temporary, whether the shocks are more durable, and so on, or the impact is more durable, and so on. And if we narrow the band, then I think there's a tendency probably to be vulnerable to the chances or probability that the changes in the policy decisions may not be on a path which is sort of unidirectional. I think there may be the changes that are more frequent in the path if we were to narrow the band. So I think the plus or minus 2% range has worked in the past, but I also have recognized that we have reached the upper limit of the band a few times. So if anything, I think I will go with the with the slightly higher upper limit of the band. Okay, so instead of 6%, probably slightly higher, but not sort of change the band itself. So I think that is my sense on the second question, the third question that they had raised. Finally, I think there is this issue of point versus band. So I think the point works better because it's not just the performance incentive. I think, I'm not sure the term Professor Dholakia used, but I think the point target probably focuses the policy direction. It is true that when the inflation rates were slightly above 4%, there were concerns that it is important to reach the target of 4%, and so I think that is the urgent I guess. But I think the point about the point target is also that the point about point target is also that I think
nobody can hear him, right?
I think we're missing him. Maybe we'll wait for a minute.
Someone bring him up, or?
So I'll finish it in another couple of minutes. Professor Bhalla, we can't hear you.
You had disappeared for a while.
Oh, I see. I don't
Now
think.
you're back.
Oh, okay. So about the sort of final couple of points that I wanted to make. One is this target of 4%, and I think the issue for me is this timely availability of data and framework that we have. So therefore the forecasts become very important. 3 quarters ahead, 4 quarters ahead forecasts are important, I think, to make a decision on the policies. As far as the inflation rate data is concerned, probably the lag is less. But as far as growth is concerned, it's actually, I think, when we consider the frequency of the meetings, we probably end up having 2 meetings without or in other words, we have the actual assessment of the growth about 2 quarters back, and the forecasts are based on whatever information is available for the 4 quarters ahead. This is something I think that concerned me a lot, and therefore the this issue of 4.3, 4.2, and not exactly at 4, I think that becomes it's not something that's trivial. I think so. The possible, especially when the uncertainties are high, I think it is important to look at this. I mean, again, the reason I'm mentioning is this is in 2024-25. If you look at the GDP growth assessment and or forecast, for example, until about I'm not sure, no, certainly about April of this year or so, April, probably June also, the forecasts that we were using were much above what turned out to be the actual assessment of growth for 24-25. So I think which is the other concern that I wanted to mention, that the data on which that we are working on is all assessments, I mean, or the estimates, predictions, and so on. And so therefore there is a need to be providing space for operating this target framework, this inflation targeting framework. And then final point, I think, is that discussion paper also talks about it. But I thought that the inflation targeting framework, so Bhalla, you said what has worked. I think it has worked to achieve a better policy coordination, I think. So it's, I mean, monetary policy targets are there, I mean, as independent targets, and I think, we are expected to achieve those targets. That, I think, has led to better policy coordination than without an inflation target. So thank you very much.
Thank you very much, Shashank. I wish you had spent a little bit more time that it has actually empirically, it has led to better policy coordination than if you did not have inflation targeting. That's obviously what you mean, but what about from 99 to 2004-5, we had much lower inflation, and I don't think we had great policy coordination at that time. But I think this is a debatable topic. I will let Ashima now take over and present us with reasons why we should. I think that the central point is, why should we accept inflation targeting? It's not like because Mount Everest is there, I have to climb it. Why do I have to climb it? Ashima.
Right, Surjit. Thank you. I think you have always said that we should go by facts and in making our assessments. And so I'm trying to present a few facts. And I agree with Dr. Dholakia absolutely, and with Prashant. We're very often working blind. We are not measuring the correct things. We are not measuring them precisely. We are measuring them with lags. But whatever it is, some measurement is better than just our working on our intuition, our hunches, or our biases. So let's look at some facts. So this is just a table that looks, it's not very precise, but looking at headline CPI at WPI, the call money rate, because very often what affected rates was liquidity, which affected the transmission, not the repo so much. And then deriving real rates from that. So we see interesting, since the last few years are annual, before that they're 10-year periods. I could spend a lot of time on this table, but I don't have time. But for the present debate, I'll just say that we see headline CPI has really come down during the inflation targeting period. And of course, Surjit will say it came down in 01, 010 also. But that time was a China effect, etc. And one interesting sort of thing is that in this 10-year period covers the oil price shocks. It includes an oil price rise and a fall. So it's not so precise, but we know that in 10 and 20, in the decade of the 2010s, you had a large earlier rise and then a reversal, a fall in oil prices, rise just after the global financial crisis. And you see here that WPI inflation over the decade is lower, CPI is higher, real rates in WPI are high, growth was lower, and in 21-22, during the inflation targeting post-pandemic period, we had much higher rise in WPI inflation, oil prices, other supply shocks, but the headline CPI rose much less, and we had a good growth recovery. So the point I want to take out, and another point I want to emphasize in this table is that the real rates in WPI go very high because of fluctuations in WPI. But in CPI, it's varied around negative to low ones to ones. And whenever it's gone above 1, for example, in the decade of the 90s, it was 2, you had low growth. Whenever, even recently in 24, 25, it touched 2, and again, you saw a fall in growth from 9 to 6.5%. Yeah. So now, if we just look at the WPI and CPI time series, you see that over the inflation targeting period, that there's huge fluctuations in WPI. We were in the pandemic, the Ukraine conflict, oil prices, but you see that headline, the range has fallen despite those large fluctuations in WPI. And that range is becoming lower in the inflation targeting period. Now, if you look at headline and core, compare these two, then this is a major sort of fact that is important for me. One, of course, that the headline is much more volatile, food prices and so on, vegetable price spikes that we saw, but still the range of volatility is falling over the inflation targeting period. And the core, ever since end 23, has been around 4% below. It fell to a lifetime low of about 3. Yeah. So core, which is more like the trend, the steadier, the more stable inflation, has been around 3-4%. And so I'll talk about some other research also briefly. Now, just touching on these questions, my view on all of them is status quo. And the reasons are that we target headline because food has a large weight in the consumption basket, which affects inflation perceptions, household welfare, wages, and second round inflation effects. And this 4 or 5%. Again, when you look at the data, the average inflation over the FIT period, I even looked at a panel of industry, disaggregated industry, as well as a panel of state data. So that average is about 5% of the FIT period, which suggests that maybe you should target 5%. But again, a disaggregate, as I said, that core is, which is the most stable or trend inflation. And research shows, Dr. Dholakia has done work, RBI itself, I've done some work, which shows that in the current period, the way they are measured now, it is core. I mean, that headline converges to core. Causality runs from core to headline. That makes sense that the more stable trend attracts the more volatile component. So in the disaggregated industry study, we find that first of all, we estimate in a GMM framework the expected inflation of these firms, and it is around 3% in this period. And there were much larger supply shocks. The pass-through is lower in the FIT period. And therefore, whatever 4% seems to be all right for the relative price adjustment, which is required in an emerging market where you have more supply shocks, etc. And the other, recently we've had that rating upgrade. And generally, as your inflation differential, our 4% is higher than, say, the US or Indonesia, more developed emerging markets, but lower than Latin America or South Africa. So it's the correct place for India to be, I think. And this means lower depreciation, lower uncovered interest, UIP risk premium, lower interest rate spreads, and therefore lower borrowing costs. So which will help growth, right? If it doesn't lead to a growth sacrifice. And I will argue that we did have a growth sacrifice. I agree with Dr. Dholakia that there was too much emphasis on that 4% and on reaching it before cutting rates. We used to really argue about this, that your real rates are going up as inflation falls, you need to cut rates. But there was again, it had become a strict inflation targeting view at that time, the dominant view. Then I'll come to that, but then the final question I'm taking, combining two, is whether point or range. Now, again, I agree with Prashant that range, the way things are measured now, has been breached in both directions. Just last month, it fell below 2%. Again, in 2018, it had fallen below 2%. And after the Ukraine war and so on, after the pandemic, it had risen about 6%. In fact, after the Ukraine war, it stayed higher than 6% for 3 quarters. And we had to write that letter. So I don't think this range can be changed at present. We should stay with it. Now, should you work with a midpoint or a lower or a higher target or a range target? But I think that inflation targeting has been really accepted by markets. And I sometimes feel that there's too much pressure from markets on the committee, on the RBI. They listen too much to markets, and they need they like inflation targeting because of the predictive aspects, is policy stability. They particularly like being able to forecast inflation and to know, the policy reaction function. And they infer a point, and even if you don't give a point, they will infer it. So it's better to, but this point needs to be very, very flexibly implemented. That we are in a flexible inflation targeting. And depending upon, I don't agree with Prashant that we were lacking growth data, therefore we did not cut rates. We have lot of high frequency data. We know theory tells us real interest rates reduce growth. So we should have worked on that. Don't wait for growth to fall before cutting. Yeah, we have to be forward looking in our policy implementation. So, but I have a lot of suggestions and changes I would like in the operating procedures. I think one of the major contribution of an inflation targeting framework is that it reduces personality-driven discretion, which is very, very, which is a big problem we have in India. And then it's the administrative services who are generalists, and they are the top regulators, and they change a lot. For somebody who's not familiar with an area, now this is a knowledge, this is specialized. They come in and they have to take decisions, and they have the dominant voice. So depending upon what they think, that first table shows that even without inflation targeting, you have periods of very high nominal rates, very high real rates. So inflation targeting doesn't necessarily lead to that. In fact, if it's properly implemented, then it puts restraints on someone who might be extra conservative and wants really higher rates. Yeah. So I think it's important to build operating procedures and institutional memory. And one issue in the last MPC of this change is that everything changed together. All the internal members within a few months, all the external members. So there's really no institutional memory, and a new team comes in and whatever they think. And RBI, I agree with the working paper has some good points, but it does not go far enough in building that institutional memory and seeing what were the problems. They seem to say it's worked well on the whole, but what were the problems? What should have been done differently? That is not really brought out. And then the other, I think again, I have some research. I have a list of references at the end. I don't want to waste time going into details here, but since there are students on this platform, maybe they'll find some of it useful. So, but one of the issues is that, as I said, one contribution is this credible anchoring of inflation expectations. So another criticism I have with that working paper is that it totally neglects this channel or this contribution of inflation targeting. There's absolutely zero discussion of it. But again, like the study we did on, and I have a problem with they focus too much on household expectation survey. In the MPC, I used to keep telling them, why don't you survey firms? They're the ones who fix prices. But for some reason, they don't do it. And there is, Abhiman does some such thing in IIM. It should be feasible to do that. So, because again, some research we have done suggests that there is, in a country like India, where hierarchy and what people at the top say is very important. In the newspaper, everything, analysts, market analysts really start repeating the RBI's forecast or converge to that, because they want to be able to predict what the RBI does. So what the RBI says and thinks is very important. So all this means that if you're announcing a 4% target and a range and your inflation targeting is credible, then inflation expectations can converge quite fast. And we all know from a Phillips curve that core or inflation expectations is a value. It can be any value. It's a historical value. Now, if it converges to a value which is closer to international inflation, that is better for your own country for reducing risk premiums and so on, as long as it's not, as long as growth is protected in the process. So if the convergence comes through inflation expectations, not through squeezing demand, then the growth sacrifice is much lower. Anyway, there are a lot of things there. It's not possible to go into this in time. But so my suggestion for operating procedures is that RBI does internally in the MPC, we used to see forecasts of core inflation, but these were never communicated to the market. And this was a longer term trend, and it would therefore help converge inflation expectations. You know, earlier in the past, we had a period when every week food prices would be collected and published in the newspapers. And this is in the early 10s. I remember, Surjit, we were together at a meeting in RBI, they were discussing this. And so we were telling them public inflation is 20%, when actually aggregate inflation is 6 or something. They think inflation is really high. What does it do to inflation expectations? The same way, all the analysts are going on about headline inflation. So, okay, you're targeting headline, but you also talk about core inflation and the relationship between the two. And then forecast. Now, as your inflation comes down, as we're approaching 4%, our inflation has fallen from 9% average in the earlier decade to 4%, 5%. Then just a vegetable price spike can really change your forecast because of the base effects. That is a major issue now. I think they should cut rates, but they believe that inflation next year will be 4.5. But that is just a base effect. So look at momentum, look at averages. Don't compare a point next year. Look at a range so that you go look beyond the base effect, because transient base effects can create large distortions as inflation falls. So that's another operating change I would like to see. Then finally, I think there should be a lot of discussion. And here again, the discussion paper disappoints that what exactly does flexibility mean? The RBI interprets it as you have a range and you have time to reach your target, etc. But actually, it is about customizing inflation targeting to emerging market needs. This needs to be clarified what it means and communicated much better. Charan Singh talks about multiple indicator approach, and he loves it because Reddy had designed it. It was designed within India and so on. So now even flexible inflation targeting can be designed in India and for Indian needs. So actually we use multiple instruments. We use exchange rate policy, prudential regulations. I think last year what happened is there was prudential as well as aggregate tightening. And I was arguing internally that we're tightening prudentially. We should not tighten aggregate. Yeah, all instruments. So we need to better understand how the instruments work together. Then liquidity management. Again, in the Indian context, canonical inflation targeting, exchange full float, liquidity is endogenous. You don't have to do anything. But in a country like India with only narrow banks able to borrow and large informal sector, etc., durable liquidity really matters. It has to be kept in surplus. And we had no say on what they were doing. They would justify tightening. You'd say, why has it tightened? They would say government withdraw cash balances, etc., etc. But so I think the MPC should be given responsibility for liquidity. We need to much more transparency. Markets were very upset with liquidity tightening. This happened in 2019, and unfortunately, it happened again in 2024. So if there's more transparency, it would increase market certainty also. So therefore, that's another change I would like to see. Then there's coordination with the government. I think we did very well. And this is something we really need in the Indian context. A lot of inflation comes from the supply side, and fiscal policy can be more effective. But since inflation targeting is lowering interest rates is conditional on reaching our inflation targeting, it's consistent with central bank independence and credibility. Although the mainstream view says that as soon as you're coordinating with the government, you're compromised, your independence goes. It's not true. No? So, but I think that we can have some formal allocation of responsibility. I've heard Ajesh say on that RBI, that RBI 90 years video we all were in. He said there that the government is responsible for commodity price inflation. Now this should be put in the inflation targeting frame, so that you have that confidence that you don't need to tighten in response to supply shocks because the government is doing something. They would be transient and so on. And this would also encourage longer term productivity raising interventions, which are very necessary to keep inflation, to reduce inflation. So I think I'll stop there. There's a whole list of references. So they can be classified into what about inflation expectations, about this broader, what inflation targeting means in an emerging market, exchange rate policy, prudential regulation, liquidity management. So anybody who is really has time and interest can go into it. I think I'll stop there. Thank you.
Yeah. Thank you very much, Ashima. Before I turn over for the questions, the reason I don't like chairing, and I've mentioned this to Ashima to Charan many times, is that somehow the perception or the belief is there that the chairperson should not ask too many questions. And I make too many conclusions. So I will take advantage of the fact that I'm the chairman and I have 2 or 3 points that I'd like to make on all the 3 speakers. And clearly, you guys have covered a lot of ground very, very efficiently and brought up a lot of issues. So I will concentrate on where I think the discussion as well as the presentation could have been a little bit more exhaustive. First, all 3 of you seem to take the Bible. There is the inflation targeting framework, there is the discussion paper, which I've asked you for comments, and therefore we accept the framework as is, with minor differences, which I'll note, and everything is hunky-dory. I find that problematic, especially given that inflation is either demand side or supply side. And it's well recognized that inflation targeting framework was not set up for supply side economics, it was set up for demand side economics. And some kind of a historical reference, especially to the advanced countries, where the only time you've had inflation in the last 25 years, meaningful inflation enough to be worried about, was during COVID time, which was a complete supply side shock. So I think that should have been addressed as to how is it applicable. I didn't find any reference to the fact that the world has radically changed, not just since 2014, but since the last 25 years. With the globalization, the way it has proceeded, it is unclear to me that any policymaker in whatever country can really change the course of inflation. I'm not saying, what I'm saying is you should accept it, but I'm saying that that is a point that all of us economic experts have to consider before we're making recommendations. And the last point, I find it absolutely absurd that even if you want to accept the institutional framework of flexible inflation targeting, that how can you, what this has to do with the RBI discussion paper, why should we waste time on points versus range? All of you have correctly noted that a range is a lot more preferable. I find the entire issue of point targeting versus range targeting to be absolutely absurd. And I'm glad on that note, I agree with all of you. I don't even know why it was there. But anyway, so let me now, Charan, you want to take over there? Basically, what I would like, I think Ram Gopal has written 2 or 3 points over here about supply side economics not being anywhere discussed as basically something in the background that we have to have. And then I think the measurement issue that Professor Dholakia pointed out has not been really taken up in any detail as to what difference, what effects it can have. And on the measurement issue, I had done this long time back. Matter of fact, I had recommended to, before inflation targeting, when Raghu was the RBI governor, that why don't, I'd made 2 points, which I'll make now, and then I'll shut up. The first point was that, instead of an MPCE and inflation targeting framework, we should have the equivalent of Humphrey Hawkins' testimony, where the governor comes to the parliament, presents whatever, answers question why they haven't kept pace or why it is too large or whatever. So that is a substitute for this entire institutional framework. One little institution, which is the Humphrey Hawkins testimony. And the second institutional framework that, which was I had, there was one other thing that I think we should have rather than this thing. But anyway, let me turn to Ram Gopal and how do we do this? Charan, why don't you take over?
Sure, sir.
You're much better at this.
Sure, sir. We have some questions in the chat box, and we have the panelists. They can read it, but you're right. Ram Gopal has raised a couple of issues. I also see there was...
1 second. Sorry to interrupt. Now I remembered what the other point was, which was much the point that Professor Dholakia had made, that we should move to the PFCE. And included in there, we should note that the major services like banking and like telecommunications, whose share has been rising, they have been showing not high inflation, not low inflation, declining inflation. So what does that do to whatever targets we might have? So I think measurement is one of the most critical issues in this. And then we can have a meaningful discussion as to what policy should there be. But first, let's arrive. And, and there are many, many countries. I think Dholakia pointed out 20 countries or 25 or 30 that use the PFCE. So why is it not time for us to do so? Thank you. Sorry. Yeah.
Sir,
go ahead, Chairman. Yeah.
Sir, we have the questions in the chat box, and I would, if the panelists want to react to each one of them. But I had a quick question for Professor Dholakia. Professor Dholakia, your own research, extensive research, shows that around 5.5 is our average threshold level. And when I was doing my research at IIM Bangalore, I was finding that a 30-year average is around 6%. And I'm taking 30-year average because keeping in mind the recent phase. Why should we not recommend a band of 6 plus minus 0.5? So we want it to be anchored, and we want growth, and we don't want a runaway inflation, obviously. But then the story would be that given the inconsistencies and the discrepancies in our measurement parameters, we understand that, and we have a narrower band. So that was one thought in my mind, which I thought I'll share with you. I also had Professor Bhide. My thought was, while you say that yes, 4% is okay, but please recollect that movement like the Arjun's, the fish eye, the moment it goes little above 4%, you see panic setting in. And then the stance changes and so many things start changing. And suddenly I feel that the message that is given to the quote unquote private sector is we are in a zone where anytime anything can happen to the interest rate. In such an uncertain environment, which businessman would like to borrow and invest? I don't. So that is my worry, that the pivot, though you may say that may not have a single point, but the pivot has to move little higher. If we are talking of FIT and we have in mind flexibility, but we, at least in practice, we are not demonstrating that we have flexibility. We sit on the anchor so tightly. So I don't know if you would have any reaction to that. And then, of course, Bhalla sir, would you want me to read the questions, or they are in the chat box and the panelists can choose to respond to whatever you suggest?
Please do. I am very bad at organizing questions and all, so you can take over. Thanks.
Fine. So I think I'll request the panelists to, and if there is anybody in the audience who wants to.
Charan, my suggestion is that you read out the questions which you think are relevant and important. Okay.
Okay, I'll do.
Okay. Okay. So let me come back. I have read the question, so let me just so I think the important questions are one relating to whether there has been any growth sacrifice on the part because we pursued this policy of fit or it or whatever it is. That's number one. Number two, Professor Dholakia's what he raised, how much has measurement confounded the issue? So are we looking, making policy on the basis of known unknowns or unknown unknowns? I think that's the second important question. And the third is, an evaluation of the IT system itself, whether it has proved its weight. But I think on the other, in terms of the target or point targets versus range, there's pretty much universal agreement. So now you can take over. Those are the major issues that I saw in the chat box.
Sure, I agree with that.
And the two individuals whose name I remember, one was Ram Gopal and the other was Rahul Chauhan.
Right.
So maybe you can call on them.
Yeah.
I don't see.
I don't know.
Yeah.
Ram Gopal, if you think your views have been expressed, then we can request the panelists to respond. you can raise your hand and come and speak, or let us know. And the same with Rahul Chavan. If you want to ask that question and word it differently, or if Dr. Bhalla has already worded it well for you, we'll go over to the panelists.
Yeah, thank you, Dr. Charan Singh. This is Ram Gopal here.
Right.
Yeah, my basic, it's a comment more than a question, is that the entire framework is emanating from the framework says basically you have excess demand, therefore you raise interest rates, therefore inflation will come down. Now, but in the entire, Indian inflation history, what we have seen is basically other than, late 90s and 2006 to 2008, around that period, barring that, most of the inflation has been supply driven. Now, using that as an excuse, IMF and RBI keep saying keep rates higher for longer periods. In our own research, this is showing as resulting in significant growth sacrifices. And RBI's interest rate action in our research is not showing any impact on inflation at all. This is the basic, fundamental issue.
Okay. And Rahul Chavan, if you want to articulate your question, or you think we have
Yes, sir.
summarized it well?
Yes, sir. Thank you so much for the insightful session, all the panelists. My question was on this 4% target measurement, sir. We know that we are calculating, like it is mentioned in the RBI's working paper that it is, the 2% as the base for the advanced economies, and 1.8 and 1.9 as the productivity differential. That this is how we are calculating the 4% target. But if you look at the the consumer baskets of the advanced economies and the emerging market economy like India, it is totally different. And the calculation of this productivity differential is also a kind of complex things. So there are issues in the measurement and the conceptualization of this 4% target itself. So we talk about 4% target, and this is the first question which I have. The second one is about the growth. We are concerning about the growth, the inflation, like sticking to the 4%, and hovering around the 4%. But what about the sacrificing the growth? Like today in India, the youth like us, we are demanding jobs, right? We need, the employment opportunities. And that is where we look, if you look at the, the USA's central bank, this Fed's mandate, which talks about the employment and the inflation price stability, where in India it is growth. When there are no employment opportunities, how the growth will be happening? And this is one more problem, whether we are more concerned about the inflation management, or we are, and because of that we are concerning, we are sacrificing the growth, or what? At this point of time, it is the 7.8% growth is not enough. This is what I feel, sir, from my side, because at least it has to be two digit.
Okay.
Thank you so much.
All right. The third question which I saw is coming from, and I think it's coming because so many professors on the panel, from Kankala Satyanarayana. While targeting the inflation in India, which tool has played the key role, the monetary or fiscal, that is demand side or supply side? Then I'll say then we go back to the panelists and I leave it to them, whichever question they would like to respond to. So I think we'll follow the same pattern. Professor Dholakia, if you want to come in first, followed by Professor Bhide and then Professor Goyal.
Okay. Now, thanks for the questions and thanks for the comments. My quick answer to the relatively simpler question is that 4% target has been arrived at by saying that 2% is the baseline inflation, which is considered as a benchmark for the advanced countries, and about 1.91 as the productivity total factor productivity differentials between the India and in the advanced countries. So it becomes almost 4%, something like that. But that assumes, this is Bhalla-Samuelson theorem, but that assumes that the nominal exchange rate will be kept stable. Very unfortunate part is that the discussion paper talks about the validity of the Bhalla-Samuelson hypothesis. But unfortunately, if you look at the things today, you don't find the Bhalla-Samuelson hypothesis being in operation. Actually, when the inflation rate in India is hovering around 2 and 3%, you still find that the nominal exchange rate has been depreciating like anything. It doesn't remain stable. It doesn't become zero. In fact, if you are applying the same logic without considering this stability of the exchange rate, then even today the 4% should become about 4.8%, 4.9%, because the productivity differential remaining the same, 1.91. The baseline for the advanced countries has moved from 2% to 3%, and this is exactly on the basis of the current global economic environment and the expected future risk to inflations. I think we consider all these things. It is no longer 2% for the advanced countries. It is already come to 3% also, which means that our rate should be around 4.9 to 4.5%. I mean, that is what it means. In any case, I was saying that the inflation targeting should not be a 0.1, but should be a range, and range should be 4 to 5%. Now, coming to Charan Singh's question, that my research says that it is 5.4%, and now I am talking about a range of 4 to 5%. Please remember, I was talking in terms of shifting already the measurement from the current things to the PFC. Now that itself is reducing the things from about 66 to say 67 basis point on an average. That means that 5.4 becomes almost 4.7. If that is the kind of a thing that you are talking about, then it makes a lot of sense. Another issue regarding the growth concerns and employment concerns, please note, we are not shifting to the employment targeting because the employment data have not been so far collected over a long period of time, and they have not been stabilized. Not only that, the employment data also do not perfectly represent the comprehensive picture. I mean, we are able to do that because we are now discussing. Had this been discussed thoroughly at the time of introduction of the flexible inflation targeting, then all these questions would have been brought down. I mean, brought to the note. I mean, the measurement issues would also have been considered. But unfortunate part was that the Urjit Patel committee was given only 3 months to come up with the recommendation report and everything. And that 3 months did not have any further time at all. It was a hush and rush job. The inflation targeting framework was introduced in a hurry. There was no such kind of a public debate and discussion on this issue, at least as much as I remember. And Charan Singh will support that there was practically no discussion before introducing. Had that been introduced, that been considered, we would have brought out such limitations. Employment right now being talked about is a very nice thing to do that, but we have to be very cautious about its proper measurement and stability in terms of the data. I don't think that is still happening. It is only a recent thing. Anyway, the last point about the measurement issues are very significant. I am saying that the PFCE is the right kind of thing because it is consistent with your GDP measurement, whereas the survey-based things, survey-based weights are not consistent, and the consistency matters. Credibility is based on consistency, not on the only perceptions. The perceptions are absolutely wrong. I think it is better to have perceptions rather than the wrong measurements as the basis for policy. This is something which I am very, very profoundly arguing. The last part is the stability. The credibility about the stability and the credibility about the policy stability. Sir, the question is that it is not the financial stability or the inflation oriented stability only. Inflation stability and financial stability is only a part of the total macro stability. Total macro stability talks about many things. It talks about the expectations about the growth. It talks about the expectations about the income. It talks about the expectations about the employment. It talks about the expectations about the borrowings, public borrowings and other things. Therefore, fiscal deficit. It talks about the borrowings and the interrelationships and the international flows, which is basically captured by the current account deficits. I think these are the kind of things. Unless these four targets are mutually consistent, there is no point in talking about separate kind of the inflation targeting alone on a standalone basis. It cannot work. In fact, it will result in serious sacrifice of output and employment and poverty. All the three things are linked. And are we at a stage where we can afford this kind of the cost in terms of sacrificing all these things, rather than considering a consistent framework and talk about consistent targeting? Thank you.
I would totally agree with you, Professor Dholakia. The way the report was written in such a tearing hurry within a stipulated time. At other points, I have argued, is there a monetary policy framework report after Sukhmay Chakravarti's 1985 report? Most of the reports, not most, all the reports before Urjit Patel, which spoke about inflation targeting, were actually focused on something else. And suddenly a chapter would be planted in it saying, hi, what about inflation targeting? You take the 100 Flowers Bloom, same thing. Take the report before that, the Bombay modernization, same thing. Inflation targeting always got a stepmotherly treatment, and suddenly it was decided it has to be done. So quickly a report was prepared, exactly the way the review report has been prepared now. So many misgivings and inadequacies are there. So I totally endorse that view. Let me go now to Bhide. If you have anything to add, please, to the comments or the question that we asked.
Yeah, I think I'll address basically a sort of an issue that has been flagged by you and a few others also. Um, I think this issue of supply side shocks and the um, uh, and so supply side shocks and whether the policy decisions have taken into account the growth sacrifice and so on, right? So I think this flexibility which is there in the inflation targeting framework, I think that clearly was a very critical feature, especially during this 2021, 21, 22. I think the policy rates were at the floor at that time for a very long time. I think so. We had dissensions on that also, why it is to be kept low for such a long time. But I think this flexibility to deal or to be dealing in the situations of supply side concerns, that is there in the framework. And similarly, I think when we saw this rise in inflation rates, and the policy rates did go up. And for quite some time, the policy rates were at a pause again at the high level. I think this is the point that I was making earlier, that the information data on growth is not as timely as in the case of inflation. And the forecasts are the only way, I think, in which these decisions are made, which is the way they should be. So why not see that 4.3% is 4%, but 4.2% is at 4%. I think it is the trajectory which is important, and I think so in order to be making that decision, which is not very stable. I think so. Maybe there's a better word for it. So I think the issue is dealing with the supply side using monetary policy. Obviously, there are limitations, but there's also the point I was making earlier, that the policy coordination was, I think, very important during this somewhat unusual times. I think the inflation targeting limitations were there, but I think at the same time, the instruments that were available for monetary policy were such that, I guess they would probably lead to more growth sacrifice than otherwise. So I'll stop here.
Professor Goyal.
Yeah, thank you. Since a lot of questions have been addressed, I'll stick to a couple of issues, which is the question that an interest rate can't affect inflation, therefore inflation targeting is pointless. I think this misunderstands a lot of things, and that is why I'm saying we need to, at least RBI needs to communicate much more clearly what flexible inflation targeting means. What does that flexibility mean? The role is that the idea is that markets, for firms, your expectation of inflation matters, for households, for wages. Yeah. And one of the major channels is through affecting inflation expectations, your target, your range. We have seen inflation in India come down from double digits towards low single digits. Yeah. So therefore, that is a major tool. It's not just the rate of interest. Now, if the rate of interest, if it is not the excess demand channel which is relevant, but the excess demand for inflation, but it is very relevant for growth. So that is why I talk about this kind of monetary fiscal coordination, where supply side shocks dominate, or there are in developing countries various bottlenecks. So if the government is spending more on infrastructure, smart infrastructure, etc., reducing those bottlenecks. If GST is cut, that reduces inflation. It reduces those toll nakas and all those kind of things that brings down costs in the economy. So therefore, if the government is doing these kind of things, and it is somewhat conservative, this consistency between fiscal deficits and trade deficits, we've seen trade deficits come down and fiscal deficits come down in India. Very, very rare, very unusual among countries in the world in the current situation. And we have the advantage of population, high rates of growth, and therefore potential revenue buoyancy, etc. So then if you have this coordination, then you can have inflation control, working through inflation expectations and cost reduction, because that kind of inflation control is happening, real interest rates can be kept low. And I tried to show in that first table that whenever real interest rates were at 1 or below 1, the economy did well. And so we have to be very, very careful that we don't allow real rates to go high. And that is a major role that the Reserve Bank plays. So I think the Reserve Bank itself, this fixation on 4 and 4.2, and you start worrying. So that is why I talked about those operating procedures. But I think bureaucrats are given an objective, then they want to make sure that they reach it. So that objective has to be clarified. If it's currently inflation with a view to growth, maybe it can be inflation with a view to, with an emphasis on growth, because we are in a sort of catch-up phase. We are in this Viksit Bharat phase, etc. And we have the opportunity to grow. It's not only growth, which is important, smoothing growth. High growth can do a lot of things, improve fiscal deficit, etc. But unfortunately, our growth has been very volatile compared to China. So flexible inflation targeting properly implemented can reduce growth volatility also. And so this growth and therefore, increase employment. We're seeing in the last 3 post-pandemic years, the average growth was 8.8%, while inflation came down towards the target. So where was the growth sacrifice? And this growth was much smoother than it was in the previous period. And as a result, you're seeing employment also increase, because when there is stability, high growth firms start employing more people. So I think policy needs to coordinate to ensure that growth is smooth and high, consistent with a stable rate of inflation, yeah, which brings down risk premiums, etc. And I think post-pandemic, we saw policy was successful in all this. And it's very important to internalize those lessons and make sure that that continues in the future. Thank you.
Bhalla sir, would you like to make some concluding observations? And then I'll make the announcements, housekeeping.
No, I just want to thank the speakers for presenting us with lots of food for thought, and really, I think the seminar went quite well. A lot of issues came up, so I'm thankful to them. Now over to you.
I think it has been a very, very important webinar. Want to thank our chair of the session, Dr. Bhalla, and all the 3 former MPC members. The richness of the discussion is so apparent as true, because it's a very complex issues. Different thoughts have come up, and I will be sharing this with the RBI. The presentation itself by tomorrow noon, we will get the recording. Request you to also ponder over it, and if you think there's intent, you are absolutely free to share with them by noon tomorrow. You will have the recording on our website. With that, our EGROW series on inflation targeting for the time being would conclude with the suggestions being made to the apex authority which deals with all this. Many a times I feel, and Professor Ashima, you are very right. I totally agree with you. As a bureaucrat or somebody who has been given the task to execute it, they are expected to execute it. It's the parliament which sets the target. And therefore, how do we convince the Ministry of Finance that the target being assigned to the RBI needs to be revisited, I think is a far more crucial, pertinent issue. And should there be a target or not a target, or is there an alternative, something that you suggested or something I keep suggesting, go back to the multiple indicator approach. I think for the parliament to discuss it, but that's a very Herculean task. But let's see if there is some will to do it. Because when the inflation targeting was implemented, the finance minister was different. And at that point of time, it was done in a very hurried way. I still do not know the political economy of it, why it was done, but it was done in a very hurried way. So hopefully we at EGROW would be able to share some inputs for them to deliberate upon. So I want to thank you, thank the panel, thank the participants. For the last 2 sessions, we have had presence of more than 120 people from across the country. Really thankful to all of them. Next week, we continue with our journey of learning from each other as far as states are concerned. And next week, we are going to have a discussion on Mizoram. We are going to be, the professors from Mizoram are going to share with us on agriculture, industry, services, overall economy, all and other socioeconomic indicators on Mizoram. So we'll continue with that. And on October 3, we are working on unexpected revolutionaries, how central banks made and unmade economic systems. And on 10th of October, we are going to have Indrameet Gill from the World Bank talk to us about the global situation. So those are the three forward webinars which we are looking at, and would request you to kindly, and the timing will be the same, 4:30 to 6. So kindly make a provision for it, pencil it in your calendars. So once again, thanks all of you. Have a great weekend and see you next Friday. Thank you.